Nigeria's Monetary Policy Committee meeting this month was rescheduled to Thursday and Friday, 16th and 17th of September. What will be the outcome of the meeting? Will the MPC stay the course and leave rates as is, or will they hike or cut the benchmark rate? Joining us to discuss further, Ayodeji Ebo, Head of Retail Investments at Chapel Hill Denham. Ayodeji, good morning to you. What did you make of the latest inflation figures, and do you think that will influence the MPC?
Okay, thanks. I think based on the trend, when you look at the cost, it's been more of cost push, and there's less control from the CBN handle. And based on this current level, it's really still on the high side. So we don't see CBN reacting based on the current inflation rate for August at 17%. If you look at it vividly, you see on a month-on-month it increased. And a breakdown also shows that, yes, we are seeing that moderation in food prices as we go into the harvest season. But the concern is that even during the planting season, there were a lot of insecurity across the country, which would have hampered in terms of planting. So the expectation may not be met as during the harvest season, and we may not see much moderation in the inflation rate as expected. So by and large, not expecting CBN to react or adjust any of the MPC rates based on the current inflation rate.
So if we bring in the Q2 GDP figure of 5% plus this deceleration that we've seen in inflation, does that then mean that they'll probably stay as is and leave the benchmark interest rate unchanged?
Okay, thanks. Looking at the Q2 2021 GDP data at 5.01%, we all know that this is just a numerical thing because it was more of a base effect. In terms of having that impact or inclusive growth, we know we are yet to get there. And as we progress, that base effect will fade out as we go into the third and fourth quarter. So I feel that the CBN won't react based on the GDP growth rate that looks impressive when you take the number, say, oh, when you compare the Q2 compared to the Q1 in terms of looking at it quarterly based on real GDP, you will discover that there was a decline of about 0.8%. So which shows that in terms of activities, yes, there may be that seasonality effect, but when you also want to just compare based on activities within the 2 quarters, it means we didn't perform as much as expected. And the inflation rate, if you look at the last MPC meeting, the MPC alluded to the fact that it's more of a structural issues. Cost of doing business is going up, and that is affecting increasing prices of increasing cost of production rather, and which is impacting on inflation rate. So that is beyond what the CBN can do. Yes, CBN has been trying to also tie the moderation in food prices to the interventions that we're seeing. Yes, the intervention into the agri sector, it's a very positive initiative, but it's also like a drop in the ocean because there's a limit to how much CBN can also commit to that space. It's more like the responsibility lies more on the fiscal authorities by creating that enabling environment. If we can take care of insecurity today, I can bet you that the form of the amount of investment that would attract to the agri sector, to all other sectors, will be very significant compared to whatever intervention that we want to provide.
Excellent stuff. I want to take you to yesterday's Treasury bill auction. No movements. How would you describe what we're seeing in money markets, particularly T-bill space?
Okay, thanks. So looking at the 91-day and the 182-day, they've remained sticky at 2.5 and 3.5% for close to 6 months. It's the movement we've always been noticing is that, or we've been seeing is at the 364-day end, that's the longer end of the curve. And yesterday, we remained at 7.2%. What we're seeing is that the government is not very aggressive in terms of raising rates. They are mindful of the cost of borrowing. And we're also aware that the government is also trying to raise Eurobond. So I think they are trying to balance what they raise locally, and that is also influencing influencing how much of rate, how much of a subscription that they're able to clear. We saw the subscription to the allotment was about 1.5 times yesterday. So we'll continue to see that significant demand at the longer end of the curve because of the differentials. You see the huge gap between the shorter end compared to the longer end of the Treasury bills, curve of the Treasury bills market.
I have less than a minute to go. Real quick, does inflation still factor in as far as real rates of return is concerned, money market, fixed income, and so on?
Yes, inflation is still will be impacting on the return. But what we advise investors is, if you can't beat inflation, close the gap. So inflation at 17%, average yield on T-bills, where you look at it at 6-7%, and for the shorter end for the bonds market, maybe at 7-9%. So what you can do is to just close the gap. Then you also need to, when you are building your portfolio, you also need to consider having a bit of exposure to dollar-denominated asset like a mutual fund. That would also help you hedge against inflation.
Great stuff. Ayodeji Ebo, Head of Retail Investment at Chapel Hill Denham. Thank you so much for taking us through those headlines.